Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of What Are IPOs? A simple guide to initial public offerings and how they work. Regulatory scrutiny. Once a company goes public, it's no longer just accountable to a handful of private investors, it's under the microscope of regulators, shareholders, and the general public. The amount of compliance and reporting required can feel overwhelming, especially for firms unaccustomed to this level of transparency. Public companies must file quarterly and annual reports with agencies like the SEC in the United States. These filings go beyond stating profits. They include executive compensation, risk assessments, and even forward-looking statements. Any errors or omissions can lead to penalties, lawsuits, or damaged credibility. On top of that, boards and leadership teams face higher accountability. Shareholders expect growth and returns, often applying intense pressure. This can push leadership to adopt short-term strategies rather than focus on long-term goals. Worst of all, any slip-up, whether it's a missed earnings report or a data breach, can tank a company's stock price overnight. In short, going public places a magnifying glass over every decision a company makes. It's a level of scrutiny some businesses may not be ready to handle, and one that requires robust systems to manage effectively. By understanding these risks up front, executives can better prepare for the challenges of going public while weighing whether it's truly the right choice for their business. The role of underwriters in IPOs. Underwriters play a central role in the IPO process, acting as the bridge between a company going public and its investors. These financial professionals, typically investment bankers or institutions, help navigate the complexities of the IPO journey. They don't just provide guidance, they actively shape and manage critical parts of the process to ensure a successful launch. Here's a closer look at how they operate. Pricing and valuation. Setting the right price for an IPO is a delicate balancing act, and underwriters are experts at finding that sweet spot. A poorly priced IPO can lead to disastrous outcomes: too high, and shares may flop on opening day; too low, and the company leaves money on the table. Here's how underwriters approach pricing and valuation. Analyzing the business, underwriters dig deep into the company's financial health, growth potential, and industry standing. They assess every factor that could impact market perception. Evaluating market conditions, timing matters. Underwriters study market trends, investor appetite, and the broader economic climate to find the best moment to launch. Estimating demand. Through roadshows and investor meetings, they gauge how much interest the IPO is generating. Feedback from these events directly influences the final pricing. Underwriters combine data and experience to suggest an initial share price that aligns with the company's valuation while appealing to investors. Their role here is pivotal. They ensure the offering is competitive yet reflects the company's true worth. Stabilization efforts. The work of underwriters doesn't end when the IPO launches. In fact, they're actively involved in the chaotic first days of public trading. Price stability after an IPO is crucial, as wild swings can scare off investors. Underwriters deploy several tools to keep things steady. One of the most common techniques is price support. If demand is lower than expected and the stock price begins to fall, underwriters may step in and purchase shares themselves to create buying pressure. This prevents the stock from falling below its IPO price, at least temporarily. Another tool they use is something called the overallotment option, or green shoe option. This gives underwriters the ability to sell additional shares, typically up to 15% more than the original offering, when demand exceeds expectations. By increasing supply, they can help prevent runaway price spikes. Think of underwriters as a safety net during this fragile period. Their actions ensure a smoother transition for both the company and investors, maintaining confidence in the early days of public trading. Underwriters don't just provide guidance, they actively shape and protect the IPO's success. From pricing shares to stabilizing the market, their expertise is indispensable in guiding companies through the unpredictable waters of going public. Trends in IPO markets. The IPO market has always reflected shifts in industries, economies, and investor priorities. Over the past few years, we've seen distinct trends emerge, especially within the tech and startup sectors and in response to broader economic conditions. These patterns reveal much about where the market is heading and what companies face when going public. Technology and startup IPOs. In recent years, tech companies and startups have dominated the IPO space, changing the game for public markets. Their influence is undeniable, driven by innovation and investor enthusiasm for high growth potential. But why have these companies become the primary IPO drivers? Tech's expanding influence. From cloud computing to artificial intelligence, technology is reshaping industries and touching every corner of our lives. Investors see tech firms as high potential plays, banking on their ability to disrupt sectors like finance, healthcare, and entertainment. Companies such as Snowflake, Airbnb, and Rivian have been standout IPOs in recent years, raising billions and drawing significant attention. Startups maturing faster. Today's startups are scaling rapidly, leveraging venture capital to hit growth milestones sooner. By the time they go public, many are already household names. Think about companies like DoorDash or Robinhood. They built massive user bases before even listing, making their IPOs major market events. Shift toward direct listings and SPACs. Some tech companies have opted for non-traditional IPO approaches. Slack and Spotify used direct listings to bypass underwriters, while startups like Lucid Motors utilized SPACs, special purpose acquisition companies, to debut faster. These methods allow more flexibility, though they come with risks. Still, not all tech IPOs succeed. Despite their buzz, some struggle post-listing as investors reassess their growth potential or business models. WeWork's failed IPO in 2019 is a cautionary tale, showcasing how hype doesn't always equal long-term success. Impact of economic conditions. IPO activity doesn't exist in isolation. Broader economic factors often steer market trajectories, creating boom years or halting momentum entirely. How do these economic shifts affect IPO trends? Market sentiment drives timing. Economic growth generally fuels a bull market, encouraging companies to go public. When the economy stalls or uncertainty rises, IPOs tend to drop. For example, rising inflation and interest rate hikes in 2022 put pressure on the IPO market, with global IPO activity falling sharply compared to the record-setting year of 2021. Investor risk appetite fluctuates. During times of high market confidence, investors are more willing to take risks. This means they're eager to fund startups or emerging industries through IPOs. Conversely, when fear dominates, smaller or speculative offerings struggle to attract buyers, and only large, established companies succeed in launching. Sector-specific trends emerge. Economic conditions often determine which industries thrive. For instance, during the pandemic, healthcare and biotech IPOs surged as companies raced to develop treatments and vaccines. Similarly, economic recovery has pushed clean energy companies to the forefront, as governments invest in sustainability and green technologies. Economic uncertainty doesn't just alter IPO activity, it also influences pricing. Companies often discount their valuations during tough times to ensure their offerings succeed. This cautious approach can help them avoid underperforming once trading starts but can also leave money on the table. These trends illustrate how IPO markets constantly evolve, shaped by innovation and economic realities. Whether driven by tech pioneers or broader financial forces, companies embracing this route must navigate a complex, ever-changing environment. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.